Hello, I'm Locke Meredith, and I'd like to invite you to join me on the next Legal Lines. I have Bill Barkas. He's a 20-year veteran as an insurance agent for State Farm, which is the largest property and casualty insurer in the nation and in Louisiana. He's going to talk to us about homeowners insurance, flood insurance, and other insurance coverages that you need to have on your home in the event a hurricane strikes like Katrina. So join us on the next Legal Lines with Bill Barkas.
Cox Communications is homegrown with local programming for you. Whether it's local sports, local arts and education, local news and weather, local faith and worship, or local stations with the best in entertainment, Cox Communications brings it all home to you. It's homegrown programming with roots, only on cable, only on Cox.
Welcome to Legal Lines. I'm Locke Meredith, and I'm pleased to have on the show today Bill Barkas. He's a State Farm insurance agent of 20 years experience. Bill, thanks for being on the show.
Thanks for having me, Locke.
I decided to ask you to be on the show because we're at the 2-year Katrina anniversary, and there's been a lot in the news over the last 2 years about insurance coverages or the lack thereof.
Right.
So I wanted to explain to the folks basically what is covered and what isn't.
Okay.
First of all, explain, I guess, for the folks, what is a homeowner's insurance policy versus a wind policy versus a flood policy?
Okay. Yeah, you're right. It's 2 years since Katrina, and that was obviously the costliest disaster in our industry's history. But basically, you've got the homeowner's policy, which provides coverage for wind, and then you've also got a flood policy that would provide coverage for flood, which would be rising water.
And the flood is not part of the homeowner's policy.
You have to have a separate flood policy to be covered for flood.
And then, so that would pay, when you say wind, what you're saying is a homeowner's policy will pay an contractually agreed amount for damage that is sustained by the home caused by wind.
That's correct.
Not by flood.
Right, that's correct. And it's going to cover, as with any policy, you've got coverage for your property and for your liability. But on the homeowner's policy, you've got coverage for the dwelling, which would be anything that is a part of the house when you move into the house structurally. Then you've got contents coverage, which is
stuff you own,
that you move into the house when you move into the house. And within that policy, there's special limits of liability for different items like jewelry and furs and certain things like that. But the homeowner's policy is going to cover for specified perils, which is fire, theft, and specifically wind, and some types of water damage if it's blown by wind. And there is the distinction between whether it's rising water or if it's wind-driven water into the home.
All right, well, let's go through these nuances because the bottom line is there was a lot of litigation over this.
Sure.
But the purpose of the homeowner's policy is twofold. One, it deals with liability.
Right.
That is your liability if someone is injured on your premises. Mm-hmm. And then it also deals with your losses or damages sustained if you suffer those perils you talked about, which again mm-hmm. are wind, fire, theft, and water that is wind blown.
Wind blown water.
Correct?
Correct.
Okay. And then what it covers, in other words, what damages it will cover depends on specifically the amount of your loss in certain areas like jewelry or furs or specific items. It has limits of coverage, mm-hmm. and if you want more coverage, you have to buy it. Mm-hmm. And then, of course, it'll pay for damages to the structure itself and other contents.
Right. Another important feature in the policy, and the homeowner's policy specifically, is an additional living expense coverage, which provides if the home is uninhabitable for anything that's covered under the homeowner's policy.
So say a tree falls in on the roof, bust it open.
They can't stay there. You need to go stay in a hotel or something for a few days, or if it's a long-term period, a year, maybe even 2 years, on some of these claims that occurred, during Katrina. We will pay additional living expense up to a two-year period.
And is that automatically provided in the policy, or is that a special coverage you have to purchase?
That's generally included in every homeowner's policy.
Now, what additional special coverages should be purchased?
You need to look real hard at flood insurance And you may not be required by your mortgage company to have flood insurance, and it may have never flooded in your area before, but it's very important that you look at getting flood insurance.
All right, let's
if you're
talk
in a-
about flood insurance. Because as you pointed out, a lot of folks who ended up being flooded from the hurricanes were out of the flood zones and were, they say, told by their insurance agents, you don't need it. And so they didn't get it. But your advice to folks is buy the flood insurance.
If you think you may be in a flood area, for example, there's certain areas of Baton Rouge that are not considered a quote flood area and would not be required by a mortgage company to purchase it. But they're in areas that potentially could flood if the levee breaks, or if you have some, you know, we're getting a lot of construction going on in Baton Rouge right now, so, you know, there's certain areas that can flood because of development going on in an area.
And what does the flood pay for? If you have flood insurance, what does it pay for?
The flood insurance is actually, it's written by insurance companies, but all the risk is taken and all the, is done by FEMA.
In other words, it's a
It's a
federally
federal
backed program.
Right. And insurance companies write the policies, but the money comes from FEMA.
So the
and
private
National
insurers
Flood.
like State Farm or Allstate or whoever's writing the stuff, they aren't really the ones that are at risk if a loss occurs.
That's right.
It is the federal government via the taxes that we pay that pays for the losses.
Mm-hmm.
Now, isn't there a cap of liability for the damages under those flood policies?
There are different amounts that you can purchase. The maximum you can purchase through NFIP, which is the National Flood Insurance Program, which is a division of FEMA, is $250,000.
So
Now,
if your losses exceed, if your house is worth $500,000 and it's blown away by a flood, the most you're getting is $250,000.
That's right.
And
Now,
will
you can
lose.
purchase flood insurance in the excess market. It is available. It's it's fairly expensive, and that's why a lot of people don't do it.
And is that a market where the private insurers provide the product?
That's right.
Does State
The
Farm
excess
provide that
flood.
product?
We, at this point, do not provide excess flood insurance, but it is, like I said, it's available in the insurance market. Another important distinction on the flood insurance is that it only provides coverage for the dwelling and the contents. There's no additional living expense. So if the damage to your home is strictly from flood, there would be no additional living expense.
In other words, if you got to move out of the house for 6 months while
That's
it's
right.
rebuilt or refurbished, you're on your own.
That's right.
Nobody's paying you money.
That's right.
Let's talk about, because there was litigation about whether or not there was coverage under homeowners because they didn't buy flood insurance because they say their insurer's agent didn't tell them they needed it, or in fact told them they didn't need it.
Mm-hmm.
The courts have kind of gone both ways based on my review of the jurisprudence. Go ahead and explain to the folks what the courts are finding.
Well, I think the big rub has been, was the damage caused by flood or was it caused by wind? And the courts are trying to work that out.
Or wind-driven water, right?
Well, when we say wind-driven water, we mean airborne, like blown through a window or door or through an opening in a roof. So there is a distinction, you know, when I say wind-blown water, that is referring to, you know, maybe the roof has been blown off and the water's blown in there.
Okay, so I'm trying to understand myself. So there would be coverage under a homeowner's policy if the water damage is from wind-blown water. And does that mean it's basically rain that is being blown
Rain
in
being
through some
blown
orifice in
into
the building?
Into the building.
So if the roof is blown off by wind and it rains inside the building, is there coverage?
If the roof is blown off by wind and it rains in the building, there is coverage.
All right, let's keep talking about this on the next segment about the types of policies that folks need to get. This is Locke Meredith, Legal Lines, State Farm Insurance Agent Bill Barkas. We'll be right back.
Television has evolved to the sensational. Cox Digital Cable is high touch with an interactive program guide anyone can use. Cox Digital is tasteful with sophisticated programming choices that stimulate, educate, and make you feel great. Cox Digital is sight and sound extraordinaire, especially on an HD set. Eye-popping clarity and 5.1 surround sound. Cox Digital lets you smell. Well, we're working on it. Experience the digital evolution with Cox Digital Cable, television for the senses.
Welcome back to Legal Lines. I'm Locke Meredith. Again, pleased to have on the show Bill Barkas. He's a State Farm insurance agent of 20 years experience. Again, Bill, thanks for being on the show.
Thanks, Locke.
We're talking about the kinds of insurance coverages folks need to buy if they suspect they're going to be in a flood area. And of course, there's been a lot of litigation over this. And as we were discussing in the first segment, the courts have sometimes found that the homeowner's policy did provide coverage because the damage was wind caused, and other courts have found in some circumstances the homeowner's policy was not applicable and did not provide coverage
Right.
because the damage was flood induced.
That's right.
And so basically, if you think it's a possibility your structure can be flooded, you better get flood insurance.
That's right.
You were mentioning when we were off the air just now that in New Orleans, they are now actually, the big insurers are basically saying you're going to have to buy your separate wind policy. Explain that.
Well, in the New Orleans area, as you know, it's very catastrophe prone, and the market is really tough down there for insurance availability and cost of insurance down there. So most companies have, either pulled out or restricted their writing down there, and they're also restricting certain coverages in the homeowner's policy. For example, wind coverage is being excluded in some homeowner policies. So what people are forced to do down there is they have to purchase not only a homeowner's policy to cover for fire, theft, and all the other perils, but also a wind policy, which really is only available through the Louisiana Citizens Insurance.
And what that is basically an insurance company, if you will, entity formed by the state of Louisiana to pay these claims. And if the folks have been reading the papers or watching TV, you're seeing that that particular entity, Citizens, is in pretty tough
Pretty bad
shape.
shape.
It's not federally backed, it's state backed.
State-backed.
Our taxes are paying for whatever losses are being paid out of that entity.
And unfortunately, it was set up at a time, and the concept was very good, but it was set up at a time that it had been established only a few years before we had 3 major hurricanes hit.
Well, and let's talk about that. Explain to the folks historically how many large hurricanes we've had in the last few years.
Well, I was looking at some, some statistics, and 7 of the 10 costliest hurricanes have occurred actually in 2004 and 2005. So 7 out of the 10 costliest hurricanes in U.S. history. Katrina being the most expensive at $40 billion.
B as in boy,
B
billion.
as in boy, billion. The second costliest was Andrew, which was at $15 billion. At the time, it was the costliest, and that happened in '92, as we all know. It happened in '92, and $15 billion, which was unheard of at that time. But again, like I said, then in 2005, we also had Rita, which was in the top 5, and Wilma, which was in the top 5.
So the bottom line is, in the last few years, we've had several very costly and damaging hurricanes.
And another interesting thing that was pointed out to me was that in '92, Andrew, obviously they name them A, B, C, D. Andrew was the first
One of the first
named
ones.
storms of the season, which occurred in August 25th of '92. Katrina was the 11th named storm of 2005. And also we had Rita and Wilma that same year.
And so the bottom line is the severity of those hurricanes is not waning as the season
getting
ends.
worse.
It's from beginning to
Yeah.
end.
And it's, the hurricane season runs from June 1st to, I think it's the end of October, November 1st. And so, you got a big window of opportunity there for hurricanes to come in.
And the bottom line is I guess what we're trying to communicate to folks is we are at risk where we live in Baton Rouge, and you're certainly at risk in New Orleans and along the coast of getting hit and suffering huge catastrophic losses.
That's
As
right.
is evidenced by just look at history in the last
Sure.
2 years. I mean, you don't have to look back far. And so the risk is there, and the probability is high that you're going to suffer great loss from a hurricane.
And most of the experts are projecting that it's just going to get worse. I mean, they're projecting upwards of $100 billion of losses. Just in the coastal areas of the United States, which would be the eastern seaboard, New York, Carolina coast, Florida, and then the Gulf Coast, we've got $7 trillion, that's with a T, trillion dollars worth of insured property in those areas.
Good gosh.
1.9 trillion of it is in New York, 1.9 trillion of it is in Florida. So, you know, the tendency, people want to live on the coast, they want to live in high catastrophe-prone areas, unfortunately. But, you know, it's fun to live by the coast and
Till the
be by
hurricane
water
comes.
until the hurricane comes.
It blows your house away.
So, you know, what's happening is, what has happened in the past, it's been cheaper to purchase insurance, let it blow down and rebuild it. So,
But that's not happening now. In fact, you mentioned it, and the people on the Gulf Coast are experiencing it. There are areas now where you cannot even get insurance to cover you in the event of a loss from a
That's right.
hurricane. And so this is a serious problem that we have in the South and along the Gulf Coast. And frankly, the feds, it sure seems like, are going to have to do something about it, because the private industries are not really, as I'm analyzing this, really going to be willing to carry this risk.
that's right. And, you know, the flood is an example of that. You know, an individual probably wouldn't be building in some of the areas that they're building, the Mississippi floodplain, if they couldn't subsidize it by the federal government through the National Flood Insurance Program. So people are really having to look at, am I willing to accept that risk myself if they can't transfer it to an insurance company
And for
or
folks-
the NFIP?
And for folks who are investing in the Gulf properties, all of a sudden they're buying a condo or whatever piece of property, and they think they've got their expenses and they're going to rent it and pay this note, and all of a sudden they can't get insurance, or if they do, it's gone up 75 to 100%.
Right.
And they got a big monkey on their
You
back.
really got to factor that in.
Explain to the folks how an insurance company actually figures out what the premium's going to be. Is there a reason or a logical process, or is it just we need to make so much money and this is how much we're going to charge?
Well, obviously, insurance companies are businesses and they're in business to make money. So they calculate what their projected losses are and, you know, what they will pay out over a period of time. And they use, you know, State Farm uses, quote, hurricane models and project what their losses will be. And they calculate that, and they calculate what they can earn, you know, as investment income on that premium before they have to pay it out. And then also expenses of paying the claims. Not only do we have to indemnify the policyholder, but we have to send an adjuster out there, and they have to adjust the claim. So there's costs associated with that. So basically you got indemnity costs, which is payment to the policyholder. You got expense costs, which are payments out, and then investment income, which the company earns. So
It's interesting. There's a lot of speculation to the process, just trying to kind of pull out the crystal ball and figure out what your losses are going to be and how much money you're going to earn.
right.
Wow. All right. This is Locke Meredith with Legal Lines. Bill Barkas, State Farm Insurance Agent. We'll be right back.
Cox Communications is homegrown with local programming for you. Whether it's local sports, local arts and education, local news and weather, local faith and worship, or local stations with the best in entertainment, Cox Communications brings it all home to you. It's homegrown programming with roots, only on cable, only on Cox.
Welcome back to Legal Lines. I'm Locke Meredith. Again, pleased to have on the show Bill Barkas. He's a State Farm Insurance Agent of 20 years. We're talking about you need to make sure you have good homeowners and flood and wind insurance coverage. Bill, let's explain to the folks, you know, you've talked about the perils that the homeowners policy covers. You need to have flood insurance. Some cases you need a special wind policy. So let's say we've convinced them that they need to get insurance coverage in all these different products. How do they decide how much insurance they need?
They can work with an agent, and an agent can help them determine how much coverage they need on their home in several ways. Number one, they can look at an appraisal of their property. They can look at actual construction costs, and then most agents have a system that they can calculate the replacement cost of a house based on certain factors, the size of the home, the amenities within the home, and other factors, and where the home's located.
So bottom line is they need to figure out what the structure is worth.
Right. Number
and they
one,
can
need
use
to
a
make sure that they know how much it's going to cost to replace the
All right,
house.
so they figure out what it costs, or what it's worth, but then there's the issue, which is what you were just talking about is, all right, well, that's great, it's worth this, but sometimes, you know, you've done your appraisal 5 years ago, and now your house burns to the
Right.
ground, and expenses have gone up 25%. So how do you protect yourself against that scenario, and is there a formula that you have to comply with to get full coverage?
Well, as an insurance company, we have to look at what it costs to rebuild the property. And that's not necessarily related to the appraisal amount, like I
Right.
said. You know, if you're in an area where the market's depressed, it may cost more to rebuild a house than you can sell it for. And right now, we're in an area, and we're in a situation where construction costs...
Prices are going up.
Right.
It's more expensive to rebuild something these
That's
days.
right. So we have to look at what it costs, because contractually, we have to rebuild the house the way it was before. So that's, from an insurance company standpoint, we want to insure it for what it's going to cost us to rebuild the house.
So the bottom line is, if I come to you for insurance and I tell you my house worth such and such, it really doesn't matter, because you're going to do an analysis on behalf of your company to figure out what it's going to cost to replace it, and you're going to give me a bid or an offer of a premium, and then I decide whether I want it or not, because there's not any negotiating taking place, right?
No. Insurance rates are set by the companies, and there's no...
That's the way it is.
It is what it is.
If you don't like it, go find somebody
That's
else
right.
if you can find them.
That's
Okay.
right.
All right, so the next question is there a formula? Because I've heard about this formula where you have to have your structure insured for at least 85% of its value. Explain that to the
We
folks.
recommend, in order for someone to get full replacement value on their house, which means no depreciation on the loss, they need to insure the home for 90 to 100% of the replacement value. So if you've got a home that we calculate the replacement value of $100,000, then they need to insure it for at least, really they need to insure it for 100% of the replacement value. We can fudge and get, 90 to 95. But what that
But
entitles
if they
them...
fall below 85%, what happens to
Well,
them?
they run into a situation where the loss that they have will be calculated on an actual cash value basis. There's really two ways to calculate the loss.
This is
Number-
important. I really want the folks to understand this, because
It
this could
is, 'cause
cost you a bunch of money.
Right. On a replacement cost, it's very simple. If you had and it's probably easier to explain with personal property, but
Let's say the
it
house
also
is a
applies-
$100,000 house. And let's say they have it insured for 70% of that.
they're only going to basically get 70% of the total loss
So
of the
there,
house. They won't-
and is the total loss valued at the 100,000, or is it valued what it would cost to replace it?
Well, if it's a total loss and they only have it insured for 70,000, they only have it insured for 70% of its value, so they're only going to get, the
Se-
policy limit of 70,000.
70,000. Now, if it has to be rebuilt,
If it has to be rebuilt, the same thing applies. Now, most companies, us included, have a guaranteed replacement cost clause, well, up to a certain limit, meaning if you insure it for 100% of the replacement value, in this case, a $100,000 house, we insure it for $100,000, we'll pay up to $120,000 to rebuild the house,
because you know it's going to cost more.
because it could cost more. And it may not, but that guarantees them that they've got a little bit of a buffer. So that's why it's really important as a homeowner that you be aware of how much coverage you got on your home and what the replacement value is on the home.
And so the bottom line is, don't be, I guess, lulled to sleep if you get your premium in for your homeowner's policy on your house, and it's the same old premium, and you know your house has gone up in value by
same old
50
coverage.
grand, and you got the same old coverage, realizing you're hanging your hiney out over a cliff.
Yeah.
And so you need to approach your insurance agent and say, hey, I want you to reevaluate this to make sure I'm properly
That's right.
covered and I'm not in trouble here.
And one problem I've seen in my time as an agent is, a lot of times on total losses, the policyholder doesn't have adequate coverage to cover their personal property. The personal property is calculated as a percentage of the dwelling. So if you got $100,000 on your dwelling, you'll have $75,000 on contents. And that may sound like a lot, but when you start adding up clothes, furniture, personal items, all those things that are totally destroyed in the event of a hurricane or windstorm or fire or something like that, then you could run into some problem there.
Let's explain the claim process. So let's say a hurricane comes and it causes all kind of, rips my roof off and it's rained for 24 hours into my house. What's the process? Call your agent?
Well, first thing to do, and even before that, we try to get people prepared. Obviously hurricane season, do all the preparations, do what you can to protect your home, hide, move things that would blow away.
And because what you got a duty to mitigate your loss. You can't say, oh, the heck with it, I got insurance, let it rain.
Yeah.
You got to try and reduce your damages.
Exactly. So first of all, try and reduce the loss before it comes, obviously. Know where your insurance policy is, know your insurance agent's phone number, how to get in touch with them.
And you need to document what you have,
And
don't you?
inventory
Run around
is-
with a video camera and take a picture of everything
Really
you've got in
important.
there.
We see that. And with water damage is not as bad, but, really any kind of damage, being able to recreate what you had is very difficult.
Particularly for a fire victim.
Sure. So video, some people video, and that's very easy to do. And then store that, obviously, away from the house. At that point, once the loss occurs, you continue to mitigate. If you have a roof blow off,
Put a
throw
blue
a tarp
tarp
over
over
it. That's right. Do whatever you can to mitigate it. If you got water in the house, shut the water off, obviously, and get the water out as best you can. Contact your insurance agent as quickly as possible, and make a list of the things that were lost. Most policies will protect. Will pay to do temporary repairs. Pay somebody to put some tarp up there if you're not able to do it. And then
Present your claim and present the
Present your claim.
documentation that supports your loss. And then hopefully the insurance company pays you what you're saying they owe, but sometimes they don't. And that's when you're forced into a litigation scenario where you basically go to a judge or a jury and argue
Right.
that you're entitled to do.
Well, and that's the best thing to do is have all that done before a loss to get that so that doesn't happen.
Bill, thank you so much for being on the show.
Thanks,
Appreciate
Locke.
it. This is Locke
Appreciate it.
Meredith with Legal Lines. We appreciate you being with us today.
Cox Media has always been helping the small businessman expand their business to, drive more customers in their door. Well, we just went on and actually we had a couple people come in and say they saw the commercial, their penetration in the marketplace. Number two was the ability to reach more people. My experience with Cox production has been great. They came in and did a fabulous job. It was just an enjoyable experience.